everybody. It is your weekend edition, the 17th of February. A wild date today. Obviously, the pain point for me with the BOIL, the Boyle trade going on. So it's definitely whiskey time, and I was going to go with a celebratory one, but I decided it was a trash day for me. I guess this is what you get for boasting. Last week, I had just a great week last week. This week, unfortunately, the Boyle trade hurt most of my gains of the week, so it put me in the red on the week, which is not a good thing. So I'm going with a little taller glass today. We're going proper 12 because as much as Conor McGregor is such a celebrity, I think he's kind of a trash-talking fighter, and I guess I got beat up today. So proper 12 it is. Cheers, everybody. Oh, Irish whiskey. Terrible stuff. Anyway, we will run through these markets from top to bottom, talk about the economic data predominantly, and of course, I've got a couple listener questions to go through here, and I got to give a shout out to Sly Dog. Always starts off with a lyric verse from a song, and I guess it's kind of a trivia thing. Do I know who that one is? I'm going to say that that's Three Dog Night, Mama Told Me Not to Come. Want some whiskey in your water, some sugar in your tea? What are all these crazy questions they asking me? I think that that's Three Dog Night. I'm pretty sure. Correct me if I'm wrong, Sly, but happy Friday to you as well as all my regulars out there. And I hope that I can do a good show. Some people are doing preemptive thumbs up. I love it. All right, so here's what we got to start. Just a simple graphic here. Yes, AI generated, and it's crazy. I guess I'm promoting Midjourney too much because all of a sudden Midjourney crashed and has not been functioning today. So I was actually trying to create a different image, but this is one I created a couple days ago, all AI generated, and it kind of looks like the week, right? The first part of the week was nice and positive, right? Monday, Tuesday, Wednesday, you had some nice gains, and then Thursday, Friday just gave it all back and ending the week negative. So not the best day out there. Let me run through our top 7, and I'll go from there, and we'll go to the economic data just to kind of summarize what on earth was going on this week. So here is, let's start with crude oil. So energy really took a drubbing today. It wasn't just natural gas, which got slaughtered today, but crude oil as well, you can see was down 2.71%. From a technical perspective, though, I think all I really have to do is just keep dragging this box out. It's been stuck in that range, and it feels to me like it's going to continue to be stuck there. You notice, for those of you who like indicators, you do have your moving average. I believe that's a 50. Yeah, 50-period moving average, now traversing sideways. If I put this to a 20, it will also be traversing sideways. So really just a ton of chop right here. And if you're a spread trader, it looks great from a crude oil opportunity because you are literally dead center. Let's see if we are perfectly dead center of that range that I drew here between $70.40 and, oh, come on, give me all at the top. 50% would be $76.80, and we are at $76.60. So a hair below perfect middle range on that zone that we have drawn on crude oil. Anyway, down 2.78%, even though the candle was horrifically bad, grand scheme of things, it just looks kind of sideways and choppy. So Pepe says, not a good time to be a swing trader or really position, right? I've been talking about this actually since the beginning of the year. My forecast was you're going to see lots of chop, lots of volatility. And we've been kind of seeing that week after week. There hasn't been a real just powerful, strong, solid week yet, right? There seems to be a couple good up days and then followed by a couple big down days. Get used to the chop out there. So yeah, swing trading is a little bit tougher right now. Let's move up the list. I still am holding my NASDAQ short, although, when you look at this price chart, I think you guys start to understand my psychology here and understanding what happened out there today. What I want to do, I was going to put a box on this, but I'll just put a horizontal line across the lows, which we established about a week ago. This is from last Friday, the 10th of February, which on the NASDAQ 100 is right around 12,243. Well, today, in the second day of just intense sell-off, came ripping down, bottoming tail, pretty much hit that zone, and then started to bounce back up. So we will face a situation next week where this line in that sand, the proverbial sand, gets more interesting because it's already hit it twice. It's bounced off it aggressively one time, therefore establishing it as a demand zone. And now we'll see if it does it a second time. We do have a hammer formation into that zone today on the NASDAQ, but does that continue on through into Sunday night and Monday's trading? I just don't know at this point. So while I'm still bearish overall, this is a little bit of positiveness for NASDAQ because it didn't end on a sour note. Yes, it was down 0.79%, but at one point it was down much more than that. Let me bring up my trend line tool right here, and I think, yeah, so it was down 0.79, but at one point today we were down 1.74%. So you had a pretty nice rip up off those lows, which tells you that there still is demand at that area or that zone. So keep your eye next week on this line right here, 12,243. If we get below that, then I think you're going to see a much bigger move down. But the fact that it's holding sideways, we could almost, it's just, I don't really see any tops there that make it work, but you can almost put a yellow box around that, and I'll just leave that one for now. So that's what we see with the NASDAQ. Margaret says NQ double top forming. Well, I don't know if I'd necessarily call this a double top. It's not close enough. Like, it would have to have risen more and gotten up into that top. If you're using the real bodies, which would be right there, right? Yeah, you could argue that we've hit that a double top, but typically when I measure double tops, I'm going off the peaks, and we just didn't get that kind of upside move. Now, here's the thing, Margaret. Don't think that, oh, well, Merlin says it's not a double top, therefore it's not. It's all artistry, right? It's subject for interpretation. In that case, what did you have? You had price rally up, hit whatever area of supply, even though it might not have been visible, there was something there that caused it to turn. Okay, we use that going forward as a potential level. Now it rallied back up. On Thursday morning, we had that little bit of a gap up and then just came ripping back down. Would you call that a double top? Well, you know, that's up to you. For me, no, because visually it didn't make the same highs at the top of this zone, which is about 12,959. I'll call that a double sideways. There you go. I like that. I think what you call this is just consolidation. Now, typically, and again, this is just going purely off of the historical books on trading and technical analysis, typically when you have consolidation after a strong uptrend, the break is to the upside. And you have some supporting factors there, right? You've got the moving averages are pointing up. You've got this nice big bullish move that started in early January of this year. Now we're pausing a little bit. You know, we might see a breakout to the upside, but I'm not going to hang my hat on that one. I'm still going to hold short. If we get above that 12,959, I'm going to have to dump my short position. Fortunately for me, I got out of some UNG just because I felt I was too exposed to the natural gas, and then all of a sudden we had the meltdown and boil over the last 3 days. So that is one saving grace. I'm not fully loaded up on natural gas, but I still have quite a bit of it. So let's move on from there because there's other indexes that share the same picture. That's your NASDAQ 100. Here's your S&P 500, which is only down 0.32%, but look at it. A nice double tap at the lower end of that yellow box, right? We've been talking about this. I put this box up about a week ago. Well, here we are now just traversing sideways. We hit that bottom level, but it's the same basic picture as you saw with the NASDAQ. So they are twinsies right now, if you will, both having hammer formations down near the bottom, demand zones, moving averages moving up, and it's been on an uptrend for the most part of the year. Therefore, this is somewhat positive. I got to say, even though I'm bearish in the markets overall, this is a positive sign for at least the shorter term for a bounce back to the upside. My fingers are crossed for a breakdown below, but we'll see if we get a follow through there. Gold. I'll tell you the funny thing about my silver today, which is great. I had sold a lot of SLV puts at $20. Collected some very nice premium. I think it was around 3%, and I got that for about a little over 2 weeks. And yeah, I'll show you silver in a second. But here's gold. You kind of have this hammer formation. You know, we talk about location, location, location. That's a good one. You got a nice big downtrend here. You got a hammer formation. It's not really at a great area of demand, right? You could argue that there's this area over here that goes back to early January where you had kind of a rally-based rally out. Maybe that's kind of your pullback point. But 1827 is kind of the important line there, the low, if you will. We'll see if it follows through to the upside. Now, let me just show you SLV because that's the one I was in. Look at the closing price, $20 and a penny. I had I was going to say too many, but I had a lot of puts at $20 even. So the fact that it closed at 20 and a penny means I keep all that premium, and I don't own the shares as of Monday. I kind of was hoping it would open close at $19.99, so I would actually get the shares put to me, but totally fine with me that I don't get it. I will sell some more puts on SLV starting next week. So that's that was kind of a fun trade. Rajesh says, Boyle is boiling me, really a little bit exposed here. Yeah. You know, and I've emphasized that. I said this is a very, very risky trade. And you notice, let's bring up natural gas here. Natural gas has got slaughtered today. Now, the good news is it bounced a little bit. If we look to this page right here, right, look at the way that chart is. On my system downstairs, I had this little range mapped out. Let me just draw a yellow box for you guys. And you really just see it's been traversing sideways. And all of a sudden today, we broke down below it, and we broke down below it aggressively. This is not a good sign because the prevailing trend is down. You had sideways action, Typically, a breakout continues in the direction of the prevailing trend. So, when we talked with John Rowland, it said I expect there to be a bounce, and we did get a small little bounce, but it just nothing sustained it. And it looks, I hate to say it, looks like natural gas is going lower. So, if you've got exposure to NG, UNG, natural gas futures, or oil, you might want to do a little bit of damage control. Now, I have a bunch. I have 10,000 shares of oil, so obviously I'm taking a pretty good hit, but I will be selling calls against that. We'll see what it looks at, what the premium is like on Monday, but sometime next week I'll probably be selling calls against it, either on a weekly basis or on for 2 weeks out to get myself some more premium and lower that cost basis on my oil, because I know natural gas will bounce at some point, so let's just keep collecting premium on that position. It's just, as they say, the market's going to remain solvent or irrational longer than you can remain solvent in most cases. Good news for me, and I hope others are not in the situation, or are in the situation, is I don't have all my eggs in one basket, right? This is just one trade that I have on, so even though I'm taking a pretty good hit on this one now, I have the benefit of time, I have the benefit of having other asset classes to help carry the load. For example, the shorts today offset a lot of my losses, so that's fine to me. Yep, I'm the same with you, Rajesh. I'll just keep selling those calls. What the tough part about this is natural gas, or oil is down 24% in 3 trading days. That's ridiculous. I mean, that's absolute pain point. Now, in order to get those gains back, oil's going to have to rally 50% just to get to where it was on Wednesday. So that's really tough for this market. And again, by lowering your dollar cost average, you make it a little bit easier. And when I say lowering my dollar cost average, by the way, guys, I am not, you're right, Mike, Miles, I won't be selling on Monday because it's President's Day and the market will be closed Tuesday. So I'm not buying more shares of oil. I won't be doing that, but I'm selling calls against my covered calls against my position, therefore lowering my cost average. Just for clarity's sake, I'm not buying anymore. Got enough exposed on that one. Merlin, do you have a Series 7 or 66 with those licenses removed, day trader status? No, I don't have a 7. I don't have any licenses. I used to have a 65, which is an RIA, Registered Investment Advisor. But when you get those licenses, that makes you a quote-unquote professional. And when you are a professional, you are limited on what you can do. You also have to pay significantly higher fees. That's typically around 10x more for data feeds from exchanges. So I will always not be a professional. I have no interest in licenses. And remember, those licenses, all they really help you do is skirt the law. They tell you what you can say to a client without going to prison. That's really what Series 7 does. It doesn't make you a trader at all. I have no interest whatsoever in having any licenses at all. But if you are going to work in the financial industry, let's say I decide that I want to go work for, I don't know, Charles Schwab, or get a job at Goldman Sachs, and I'm on the sales end and I'm working with customers, I would have to have licenses, so I now know what to say to my customers. But for the most part, they do not make you a better trader. And you can be sued easier. Yeah, right. But again, I'm not going to touch anybody else's money. So for people who might be new to the program, remember, I will never ask you to trade your money. I have no interest in it, and don't even ask me. I'm not going to solicit you on Instagram or LinkedIn or all these different group chat things trying to get your money. It's crazy how many people are trying to steal money. Every day I post on Facebook for this show, somebody with my perfect identity, he's got everything copied, instantly pops up and starts soliciting to send in Bitcoin, and I'll give you free Bitcoin. I will not be giving you anything for free. Just tell you that. Ganesh says, on your oil trade, shouldn't you exit on a stop loss rather than hold a loss, making the trade? Asking, is that the principle retail has to follow? Correct. You do have to follow that as a retail trader. But I am, in this case, I am a retail trader as well. I'm not institutional. I am playing the benefit of time. Now, my only problem that I have personally with this is it's oil, which is a double leverage one. So that was my mistake, but it's fine. I had the benefit of time. Again, this is not a trade where I'm going to be getting overly hurt on. At some point, we will see oil come back to the upside, and I'll be continually selling those calls. And I'll just keep lowering my dollar cost average till there is a rally. As you know, with all commodities, you can go through long periods of down moves and it gets really painful, but then you go through the exact opposite where you get these long periods of up moves that become very bullish. And right now, obviously, natural gas is just getting absolutely slaughtered. It's an ugly crime scene here. We're seeing levels, it's lower, it's going all the way back into 2021 of December. So it's certainly giving back a lot. But if I go out a weekly here, we are, I got too many lines on this chart. Sorry. All these lines from when John Rowland was on. Do we end up getting down to this $1.50 that we were back in 2020? It's certainly possible. I really hope not, but it's possible. I hope not. Like I say, I will not be adding more to my position, but I'll just continue to sell those calls against it and dollar cost average it. I have the benefit of time on my side. But normally, yes. This line right here, where it broke those lows, that's your normal out. Does double leverage hurt more going down than it helps going up? Yes, it does. Yep. It's actually much worse. So, the fact that you had this huge decline today in Boyle, right? You're like, 12%. At one point, it was down like 15%, but it was finishing down 11.5% on the day. Because it's double, it has to work harder to gain those losses back, right? It's a double thing. No real supplies on. Oh, there's a couple. I do like this $10 area, but this is on Boyle. But that natural gas chart, you're looking at about 346. But I don't think that's the spot. I was actually not looking for a huge move in natural gas. I was looking for a small pop here on natural gas, but that didn't even come. It really kind of sucked. Definitely sucked. All right, let me go continue on. I almost made it to the top of the list before I get sidetracked. Oh, look, squirrel. Russell 2000 was your third place finisher. This is a different pattern than you're seeing with the other indexes, right? I forgot why we put this giant box on here. Oh, yeah, because it's got a massive range. I am interested in this current formation on the Russell because it's really forming a pennant formation. Let me zoom out just a hair to make it look a little more pronounced. You look across these lows that's been forming, and across the highs that has been declining, you have this little pennant formation that's developing on Russell. Now, again, that is the same thing as you would look at with the other indexes, which is a rally into a chart formation. In this case, it's a pennant, and the other ones we were having a sideways action. This is a bullish pennant formation. So odds are higher that these should break out to the upside. But again, everything works until it doesn't. Have a plan in place. Next on the list, Bitcoin. Surprisingly, even now Gensler's going after Terraform Labs and all these other crypto projects, it's still rallying. Kind of very interesting to see such a huge rally in crypto right as regulations being slapped on almost every crypto project out there. So 0.93% gain today. At one point, we were over 25,000 today, same as yesterday, but gave back a little bit. Still, the fact we're closing at these levels right around 25,000 is really good. I'd love to see a close above 25K on Bitcoin, and then we'll really start to see some moves here. As you can see, there's not a lot of overhead supply until we get to like 29,000. So if it closes above 25, I do think 29 could be in play very quickly, especially the way that this thing's moved. Your dogs too, huh? Man, I say that. If I say the word squirrel, my dog will bolt outside and start barking at the fence because I got squirrels that run around all the time. And lastly, the best finisher on the day. Is it possible we had a best finisher? Actually, it wasn't best finisher. They've changed. Bitcoin's actually the best, but because it's moving up in after hours, because it actually continues to trade. But here we have Dow. And again, I don't see Tom here today, but this was basically what we talked about, that just giant sideways action going sideways. Moving averages, horizontal. This is a great opportunity for a spread trade because it's just traversing sideways. Hey, mahalo, Nestor. Okay, let me go to a couple charts here just because today's week really kind of threw so much information at me personally. It's kind of like I have to reevaluate what I'm thinking about the markets going forward. Now, obviously, I am intermediate term bearish. As I mentioned at the beginning of the year, January 1st, I thought we'd see a very positive Q1, markets showing some nice gains, slowing down in Q2, and then Q3, Q4, felt like we'd see things dropping lower and lower. Oh, there's Tom Bar. There we go. There you go. Good. Good. I hope they work out for you. I mean, this is such a great chart. And what's so wonderful about those, Tom, you have to appreciate this as well, is the average investor looks at this and goes, this thing's crap. Dow's doing nothing. It's just going sideways. You're not making money. It's like, yeah, well, you got to know your instruments, know your asset classes. In a perfectly sideways market, that's somebody else's dream market, and that will be Tom Barr. All right, let's look at the economic data just because this is a conundrum, if you will, that really sent this market reeling as far as what is the Fed going to do about these markets going forward. So here is CPI, Consumer Price Index numbers, which, as we know, is a completely manipulated data source or data set of consumer products that give us an idea of inflationary pressures. Now, what's strange about this one is how it really just surged up in this final, in this most recent reading, right? We had a 0.5 number. That was actually the forecast, and it came out right in line with that. So, or actually, we thought it was going to be 0.2. came out at 0.5. So that was higher than expected. That caused everybody to go, wait, hold on a second. That was Tuesday. We followed that up with the retail sales number. Now, retail sales was on Wednesday. I'll go straight to PPI just so I can get the inflation data to back. The CPI number was really high. The question was, does that translate over to a higher PPI, which is producer price index? And lo and behold, what did we get? We get a 0.7 reading. You can see this little gold dash mark is what they expected it to be, which was 0.4. And here we are all of a sudden, popping out at 0.7. That's pretty bad. I mean, that's a sign that people were way off on their estimates on producer price index. And of course, that could pass forward and translate into higher inflation for consumers going forward, right? PPI is producing the products. CPI is what we pay. So this is a piece that I guess startled the markets. Now, what does it ultimately mean? At least for me anyway, it means that this talk, and I had my note here from when Jerome Powell spoke the other day. What was the word? We are in the early stages of disinflation. What we might get at the next meeting is that talk track changing, because if all of a sudden you're seeing these numbers surge again, that's not disinflation. It's just we're back in the inflationary stage that we were in. So let's go look at the Fed funds futures to see, yes, Robert, NASDAQ, Bitcoin's pretty much following the major indexes. Now, I think you'll see that separation soon as we get some regulation on it, but we can talk about that a little bit later on. So March 22nd, we've obviously got a month to get to the March meeting, but notice the shift, right? It was like 95%, actually 90%, that we're going to get a 25 basis point increase at that March meeting. It's now 84, and over the past week, it's changed. We're seeing more probability of a 50 basis point increase. Now, why is that? That's because of this data here, right? That this inflation number has people thinking that the Fed may say, we're going to continue to keep that pedal to the metal just because we can't let inflation rear its ugly head. Remember what Jerome Powell said. He says, ongoing increases are appropriate. He says, it is substantially, he says, there's more risk to not doing enough. So my bet is, if I had to wager today, that we're going to start to see this over here tilt. And you're going to start to see more probability creeping in of a 50 basis point increase. Because if those numbers keep popping like this, the Fed's going to have to be more aggressive. So just keep that in mind over the next couple weeks until we get closer to that Fed announcement. I'm anticipating that the probability gets higher for a 50 basis point increase. Doesn't mean we're going to get one, but just the market's going to start to think more about that. And I think you can understand that if the markets and the big traders are thinking, hey, we could go from 25 basis points and maybe get 50, that's going to start to have a negative impact on this market. So just something to keep an eye on in the next week or two as we get closer to that FOMC announcement with what the Fed might do. All right, last piece. And I guess I need to take a sip of whiskey here real quick just because I'm on retail sales, and why not? All right, so let's get you guys interactive on this one. The logic of market says that your retail sales numbers for November and your retail sales numbers for December should be stellar, right? They should be great numbers because that's your Black Friday sales, that's your Christmas shopping, your holiday shopping, whichever holidays that you decide to celebrate. But that's when we spend, right? That's when we just go, I'm saving up. I got to buy that new Xbox, brand new one that I can't get for 7 months because it's on back order, but I'm paying a premium for it. Right? That's how crazy we get with this stuff. If you look at this retail sales numbers, here is the November number. Let me see if I can draw on the chart here for you without advancing the slides, which always happen. There we go. This first one right here, I'm drawing a little arrow to underneath it. That's November. You have December. And then all of a sudden, January's numbers come in here. And you're like, wait a minute, how does that happen? Well, notice when I put this red box around it, notice where it sits with regards to the year. It's really kind of interesting how this data plays out, and it seems to be a pattern. So for example, if you notice where this candle specifically lines up, it's right after the big vertical bar. Well, notice what happened in 2022. Your January numbers for 2022, off the charts, and we beat it. Notice the ones for 2021, off the charts, and we beat our estimates. So this is definitely a pattern that seems to be recurring over time. What is noteworthy for me is it tends to be the highest for the year. So we'll probably see the next retail sales numbers come in significantly lower. It'd be nice to go back and see what has done a little more time than this, but I thought you guys might find that interesting, that there is this pattern that shows that January reading is usually very high in beating expectations, and then we correct ourselves and get back to normal retail sales. Remember, the more retail sales we see, the more spending that we see, the more likely CPI and PPI numbers will increase. Demand is reflected by retail sales. As that number surges, then you'll probably see CPI numbers increase as well. That said, our next month's reading might even show a decline, and therefore we might see a reprieve in CPI. So again, a lot of those, when you open that watch up and you see all those cogs and wheels in there keeping time, this is just one of those little sprockets inside the watch that's keeping track of time. Are retail sales numbers literally reporting just sales, or does profitability come into play? No, just sales. Doesn't do with profitability. It's saying what is selling, right? Is it cars? Is it microwaves? Is it TVs? Is it USB drives? And it's all this assortment of different goods and services. What's really selling, right? That's what it measures. It doesn't go by profitability of companies or anything like that. It just says what's moving, what's the demand like for different products. So that's your major economic stuff. And, I think that going forward, it will become more in play. Next week, we actually have a very light week with regards to economic announcements. Of course, you have a holiday, President's Day. Most of the major markets are closed, so we'll have to wait and see how that pans out for Tuesday. I'm not going to do a show on Monday just because it's President's Day and I have a lot I need to catch up on. So I know, no show on Monday. Got to take some time out for myself. So let me go to some listener questions here. Jeff sent this one in, and I will, and of course, answer your questions if you have them. Type in a chat with a couple question marks so I know which ones are dedicated to me. Jeff says, I've got a question regarding bonds and how to read the day's progress as they scroll on the bottom of the TV on Bloomberg. Negative numbers are green, which to me would indicate the bond went up. The 5-year is 0.53 basis points, which I would think it would be good, but it's red, which I think would be bad. Can you take a few minutes to explain this? Okay, so everybody's going to report bonds differently. Remember, bonds are this weird inverse product. As bond yields rise, that's bad. You don't want bond yields rising. Now, again, we are in a situation where we have an inverted yield curve, so many would argue bond prices rising, it might be a good thing. However, historically, a rising bond price, if it goes up 53 basis points, which is 0.53%, that means that those bonds are commanding a greater yield, meaning the cost of capital is going up. So any business that's looking to expand and using capital markets, they're going to have to pay more to people to get money. So again, if you run a business, say I got Merlin's widget factory and I'm like, hey, I want to raise some money and I go sell some bonds. Well, because the 10-year or that 30-year are rising so quickly right now, well, in this case, they're declining over here. But as they rise, it's more expensive for me. So when you look at this picture, you can see here on the hard red edge, you have the 10-year and the 30-year, right? We'll just look at the 30-year. 30-year, it says 3.81, down 41 basis points, and it says green. What that's showing green is it's the cost of capital is declining, so that it's cheaper for you to get money for 30 years. That's technically going to be a good thing for environments. The lower the bond yields are, the easier and more accessible money is. So that's why they're showing it this way, because the impact of bond yields falling means money is cheaper, and that helps grow economies and businesses. On the left side, you got the 2-year and the 5-year, right? Focus on that 2-year. 4.53%. It was up 95 basis points. Man, I wonder what time frame. That's a pretty steep rise right there. That's almost 1%. That's huge. 2 years up 95 basis points. As that rises, that makes it harder for companies to borrow on that 2-year, right? It's more expensive. So the cost of capital is rising, therefore choking out potential growth for businesses. So Jeff, that's really why they're reflected that way. Green is good because yields are dropping. Reds are bad because they're rising and making it tougher. All right. Hopefully that answered it, Jeff. If you're here, if you're not, I'm sure you'll type into chat and I can get a little more detailed explanation of that one. All right. That was it. I really didn't have that long of a show planned for today. I was going to try to get, it would be amazing if I actually did a 30-minute show, but I'm sure you guys have questions for me. So feel free to type them on in as I have a sip of this Proper 12. Thank you, Conor McGregor. Higher retail sales is bad for inflation, but at the same time, it removes the recession question. Right, and Ganesh, that's the tough part. You want retail sales because that's purchases, and that's good for businesses, right? That's good for bottom line and earnings, and it's growth. However, too much of it can drive prices back up, and now we get that inflation question. So it's kind of that catch-22, right? Retail sales, yeah, spending good. And it's like, oh, wait a minute. We don't want that spending because we want prices to come back down. So it's a slippery slope, and I really don't know how to fix that one. You know, I'm not an economist, so I guess I am technically with all the work I've done over the years, but I have no interest in doing Jerome Powell's job. But that's what he's got to figure out. You know, if we get record retail sales growth, inflation's coming back. There's no argument. The reason they're raising rates is to try to choke out consumption and slow down retail sales. So that was a pretty bad print. I think that's part of the reason why you saw these markets freak out on Thursday and Friday. It's okay. It's not the proper 12. I wouldn't go buy it again. It was a gift. So there's plenty of other really good ones out there. Are bonds in the USA linked to mortgages? No. Mortgages in the US are linked to bonds. It's the other way around. So typically your 30-year fixed rate mortgage is going to be tied to the 10-year bond. Typically. You can find bond products or mortgages that are tied to other things. They used to tie them to LIBOR, but that no longer exists. Let's go out here and show you that 10-year. Right? You had a 1% decline today in the bond prices. Let me get rid of that. So here's your 10-year. Right? You can see the problem. If you go back here into 2020, you could get a 30-year fixed rate mortgage, which is based off of the 10-year. You could get a 30-year fixed rate mortgage for about 2.5%, which is pretty damn good. Now you're looking at 6, maybe 7% for that same mortgage. It's just the yields have gone up because the 10-year has soared from these lows in 2020 of 0.33 to highs of 4.33%. And, the general consensus is that this is going to continue to the upside, that you're going to continue to see this move higher and higher and higher as that yield curve gets back to normal, because the Fed's not going to lower the short end of the yield curve, right? The 2-year or anything like that. It's the long end that kind of free floats. And that would mean things like, if you expect yields to keep rising, then you go short TLT, because TLT is the inverse of yield. It's the price. As those yields get higher, the price of bonds decline. So there we go. And one potential opportunity there. We started last year with 2 quarters of negative GDP, but they changed the definition of recession, so no recession then. What's the definition now? Who knows? Who knows? And remember, there isn't a clear, definitive definition of what a recession is. The industry has labeled it as 2 consecutive quarters of declining GDP, right? That's what the industry says, but that's not what the economists said. That's not there is I forget who actually does it. I don't think it's the Bureau of Labor Statistics. It's something like the Economic Research Board. They will be the ones to say, we are officially in a recession. And what's that criteria? We don't have it. So certainly 2 consecutive quarters of declining GDP are an important one. You could argue high inflation might be another piece of that. So there's different components that add to it, but there isn't a clear-cut definition, unfortunately. Where's the good boy? He's downstairs. He didn't want to come up and go in the show. A recession is where you lose your job, or somebody loses your job, right? It's not everybody's losing their job, but it begs the question of, when does that recession turn into a depression? I don't know. These are things that seem to be a moving target, if you will. It's like we hear so much about, hey, we're going into a recession, but it feels like it just kind of keeps changing. And, well, we're not in one yet. Just look around you and look at the price charts, and I think that's a better way to analyze if we are in. Let's see. Santosh says, I've been planning to buy a house and have been saving some money. What is a good short-term, low-risk place to park it to get some interest out of it? Look, you could buy bonds. You could get some yield on bonds. You could get a 2-year right now, getting you 4% we talked about. 10 years going to get you 3.8. Bond markets will get that interest stream. Again, for me, I would go and if I had money sitting there, I would put it into account. I would be selling options, collecting premium, which would get me a much higher rate of return than any savings or CD account. But that requires a specific skill set, knowledge, and options to do that. And I would do them just so deep out of the money that I'm not concerned about getting exercised. But that's how I would do it. As far as a low-risk investment, there really isn't anything that I would call a low-risk investment at this point. Certainly going bonds will get you some yield. Going in a savings account, that's probably a sucker's bet. You're not going to make any money there. If you knew you were going to be locking in for a certain amount of time, maybe you could do a CD, right, and maybe get yourself 3% there. But I think you do much better if you understand different asset classes, like options. What will be the effect of higher interest rates in the markets? Bearish, bullish. So the effect of higher interest rates is bearish for the market because it chokes out the economy. Just exactly what I was just talking about, this graphic here from Jeff. When you see these interest rates rising, you notice posting it in red. So as they continue to rise, they're going to be more red. And the reason for that is it's the cost of business. Whether you're getting a loan, if you want to get a loan for a car, you could have gotten 0% financing a couple years ago. Now you're not getting 0% offers from car dealers. So it's harder for people to buy cars because there's no teaser rate interest. If you're going to buy a home, you could have gotten one for 3%. Now you're looking to pay 7s. It's going to prevent people from qualifying for homes. So the higher those rates get, Zed, the more difficult it is for the economy to thrive, which is why the government did quantitative easing rounds 1, rounds 2, round 3, Operation Twist, and all this stimulus just starting in 2009. Right when that market crashed in 2009, money was just literally like a rapper at a strip club. It was just making it rain. Money for everybody. Boom, 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 boom. And we got so addicted to that free money everywhere. What that did is that dropped yields, and yields plummeted till they got stuck near historic lows, almost talking about negative. Now, when those yields are at 0, or 0.5%, money's cheap. Businesses can borrow and just blow up their businesses, expand, bring on employees, take on debt because it doesn't cost you anything. But now all of a sudden the cost to grow your company and bring on employees and build out infrastructure and R&D research all got significantly more expensive, especially for companies that are spending billions of dollars on it. If you're borrowing money, it's really expensive. Well, and let me take that back. It's not really expensive. It's still relatively cheap compared to historical norms, but it's far more expensive than it was 2 years ago, right? So this will choke out certain aspects of business growth, which in turn will cause them to rein in their business. And what have we been seeing? Layoffs, right? A lot of companies going through layoffs, which is another sign that they're starting to either slow down or trim overhead because the cost of capital is so high. So it's all one giant domino effect, Zed. But yeah, rising rates hurt the economy. So, and that's the trap. They're trying to fight inflation, which could hurt the economy even more. But by raising rates so quickly, you're hurting the economy. So at some point, they'll get back to even, but it's going to take a little while, I think. Liz says, maybe the SEC can help, but by definition, not the job, I know. But they are good at making things up as they go. Yeah, I wouldn't trust the SEC to make a definition on what a banana is. They're unbelievably inept, in my opinion. Even though I think that Gary Gensler is an intelligent person, it's shocking what some of the stuff they're doing. It's like, do you have any clue? I mean, do you guys actually know what markets work? How much of these definition experts get paid to be? I would love the guy I want to be. You guys know my dream job. My dream job is to be the guy that does crude oil inventories. I want that job because you can be the biggest failure on the planet and still be heralded as great. Let's see, what was the last number that came out? Just because you got me on that topic. Let's go to Wednesday, crude oil inventories. Oh, yeah, look at this one. So they were expecting there to be, the previous number was 2.4 million barrels. They thought that was going to drop to 1.5 million barrels. And it came out at 16 million barrels. How many baseball stadiums does that fit in? 16.3 million barrels of oil, and they thought it was going to be 1.5. Like, that's like you going to your boss and like, he says, how much money do you think your department's going to spend this quarter? I think we've got a $100,000 budget this quarter, so we should stick to that. And all of a sudden, at the end of the quarter, it's like, so how much did you spend? We were about 1.1 million. It's like, but your budget was $100,000. How did you get at 1.1 million? Anyway, cracks me up how off they can be. Anyway, let me wrap up here. I got stuff I need to take care of. I was actually going to target a 38-minute show or 30-minute show. So, no. Don't hail me as great. I'm just a guy trying to live his life. That's what's, yeah, right? A clown would be more accurate. A monkey throwing darts would be more accurate. Like, how can you be? And let's be real here. A barrel of oil, I believe, is what? It's 55 gallons, right? I think it's 55 gallons a barrel. Those big, giant barrel, that's a barrel of oil. 16.3 million of those. That means that this person was off 14.8 million barrels on their calculation. And I don't know how much space that would take up, but I'm willing to bet you that Wembley Stadium would be filled from floor to the absolute rim with barrels of oil and still be overflowing. That's how off they are on inventories. It's mind-boggling. Anyway, the whiskey's good. You got me in a bit of a rant. Let me wrap up here. There is no economic announcements really happening. Of course, President's Day. No, a barrel's not, barrels, I think you said 5 gallons. I'm like, I know it's not 5 gallons. That's a pony keg. That's what beer comes in. Anyway, I'm going to wrap this one up. I'm not going to do a show Monday just because I have things I need to take care of. I really want to focus on Monday and actually work more on my book because Larry Jacobson is pushing me, as some of you are. I just need to get one done. I got 3 in the works. I'm like juggling these things and they're not getting done and I'm just not focused on it. So I'm going to spend a little more time focusing on getting that book done. Actually, it was funny. I was teaching some classes here for some friends of mine on personal finance. Just sitting in my living room doing personal finance stuff, and I'm going to put a lot of that in the book as well, as most people I think aren't prepared personally to become wealthy because they're not making the right financial decisions, which is the first book I'm trying to finish. The missing oil is called the strategic reserve. It's the strategically, I don't know where it is reserved. Anyway, so no show on Monday, no real economic announcements, and there's really nothing happening in the earnings calendar. So Tuesday will be the bigger day for action in the markets. I hope that you had a decent trading week. I know it's fairly choppy. I think next week will be a lot more calm as everybody just kind of digests this information, and we might start to see slow trending markets next week. I don't think it'll be big moves. I think we'll see slow trending markets next week, which is a welcome for me. I like it all except when they go horribly against me, like natural gas did over the last 3 days. But it is what it is. We'll make up for it in other trades that I make. So thank you guys so much. Again, if you have questions for me, send them in at TraderMerlin@gmail.com, or you guys can put them down below any YouTube video. I will see you on Tuesday, and Mike, I will see you on Saturday. Thanks everybody. Have a fantastic remainder of your weekend. Do something fun. Live your life. I'll see you on Tuesday. Take care.